If you can turn raw data into the right information at the right time, you directly influence how well a business is controlled and how much value it creates. In this lesson, we link management control systems, the information they need, and the way value is created across an organization. Let's start with the core idea of a management control system. In management accounting, this simply means a formal way for managers to measure what their teams actually do, then correct that performance so the organization achieves its objectives and plans. Think of it like a GPS for the business. You set a destination, you track where you really are, and you keep steering back on course if you drift off. The whole point of the system is to turn plans into actions that really happen, not just stay on paper. The management control process follows a clear cycle. First, managers decide what should be done and what results they want. Then they document the plan using standards or targets such as budget figures or output levels. Next, teams carry out the plan and managers measure the actual results produced. Those actual outcomes are then compared with the standards or targets in the plan to see where performance is on track and where it is drifting. Once the comparison is made, managers judge whether action is needed. If it is, they implement corrective measures such as changing processes, reallocating resources, or revising targets so the organization moves back toward its objectives. Management accounting information sits right at the heart of this control cycle. It supplies both financial data, like costs and revenues, and non-financial data, like units produced or customer complaints, that are needed to record plans, compare actual results with those plans, and evaluate the differences. Without that information, the control system is blind. With it, managers can see where value is being created or destroyed because they can track performance, spot problems, and take informed decisions to improve outcomes. To understand information needs, the study guide uses Anthony's hierarchy, which separates management activity into 3 levels. These are strategic planning, management control, and operational control, and they correspond to strategic, tactical, and operational information needs inside the organization. Strategic information supports senior managers who plan for the long term and oversee overall control of the business. It comes from both inside and outside the organization, is highly summarized, covers the whole business, mixes numbers with qualitative insights, is often produced when needed, and can never give complete certainty about the future. Tactical information is for middle managers who allocate and monitor resources over the short and medium term. It is mainly generated internally, produced on a regular schedule, summarized at a lower level, focused on particular activities or departments, largely quantitative and designed to track performance against specific goals. Operational information is used by frontline supervisors and foremen to plan and manage specific tasks in the immediate term. It is almost entirely internal, highly detailed, produced very frequently or even continuously, tied to particular tasks, and largely quantitative, often being the direct processing of raw data coming off machines or systems. To see why processing matters, we need to separate data and information. Data is unprocessed facts, events, and transactions, such as individual sales or survey answers, while information is data that has been processed into a form that is meaningful and useful to the person who receives it. In other words, data is the raw input, information is the finished output. When we process data, we turn scattered facts into knowledge about circumstances, so managers can actually understand what is happening and make decisions that help create value. High-quality information has several key characteristics. It must be relevant to the user's purpose, give a complete picture, be reliable and accurate enough, be clearly presented, inspire confidence, be sent through appropriate channels, be limited to a manageable volume, be produced at the right time, be comparable over time, and deliver benefits that are greater than the cost of collecting and preparing it. A worked example from the text shows the difference between data and information using a market research survey. Members of the public fill in questionnaires about a product or service, and those completed forms are just data, a collection of individual responses, facts, and opinions that have not yet been organized. Researchers then process and analyze this survey data, turning it into a structured report that summarizes findings and patterns. That report is information because management can use it to decide whether to modify the product, change pricing, or adjust marketing. Now that raw data has been transformed into meaningful, decision-oriented knowledge. So in your exam and in real practice, remember this thread. Management control systems use processed information, not raw data, to keep plans and performance aligned and to support value creation at strategic, tactical, and operational levels. If this helped, subscribe for more clear walkthroughs of the CPA Management Accounting syllabus.